Welcome back to Golden Rule Radio, everybody. We've got Tori, Miles, and Rob in studio. Tori, kick us off, buddy. Show us some numbers.
Well, we're finally coming down. Down, down, down she goes. Where she stops, only Miles knows. So we're going to throw them under the bus here in a little bit. But as we record, $2,007 on gold, down about 15 today. Silver, $22.55, $22.60 as we record. And platinum, under 900, so at $892. And it's trying to allow palladium to catch it. It just isn't happening quite yet, but palladium's at 936. So those white metals are really having a pullback, and that has driven the gold to silver ratio for 1 to 89 to 1 today. So that ratio keeps creeping. So, Miles, you've had some great charts here in the last couple of weeks. Anything change in terms of your support levels with those either white metals or gold?
Yeah, well, my support levels aren't really going to change until we see some higher highs or lower lows, relatively significant. Now, we did have some short-term lower lows here in gold, and gold, I would argue, has definitively broken through that first reversal point around 2020, as we've now pushed down to just above 2,000. I think we're at about 2,005 at time of recording. So I'd be looking for a pullback down to the December lows, back around December 12th, December 13th, which is going to put us at the 1980. If you remember last week and the week before, I kind of had some $40 descending numbers, 2020, 1980, 1940. And then my last one, which I hadn't mentioned, would be down around like 1885. So that first 382 fib, that first little pullback level, I wasn't too surprised to see that get breached again, especially because that second attempt we made up on the top end back right after Christmas failed to get to the early December high where we put in that new all-time high. So realistically, ever since we put in that all-time high back in December, most of our trading has taken place between this 2020 number that we just broke and up around like 2060 with a little bit of a break above to 2080, 2090. And then that previous dip I mentioned back on December 12th to around 1975. So I think we're on our way down to it. That's going to continue to let the 200-day moving average come up to meet it. And I think it'd look really nice if we get a touch to a previous low, that December low, which lines up with the current 50% line on the fibs, which would also line up with the 200-day moving average. That would be a pretty healthy 2-step forward, 1 step back. See that happen here January, early February, and then we're getting into the spring when we do tend to see some runs in metals to the positive. So I think gold is following a pretty consistent plan and pattern. I know for people that maybe check in with gold every couple of months, it either looks amazing because you happen to look at gold on the days it's up, or it looks terrible because you happen to look at gold on the days it's down. But stretch this timeline out long enough, gold over 10 years, gold over 20 years, gold over 30 years. You know, I think back to when I first came to work here and gold was $300. It's over 2,000 now. I think it's holding its own compared to some of the other things over the last 20, 30 years.
Holding nicely.
Well, I think Rob started with us when gold was 50. Certainly he's seen it in his lifetime, so
Right.
we'll see.
Oh, yeah,
it's just a
definitely.
matter of, he was just a little too young
I
to
think
hire.
Rob started when gold had only existed for
there
50
you
years.
go. There you go. Well, those are great supports, and silver has not broken down to the downside or out of that.
No, but it's real close. You know, we had the same like December 12th, December 13th low at like 2250, 2251. We touched it again here last Thursday, and we're right to it again. So there's really no momentum to suggest that silver is going to turn up from here. Could, you know, anything can happen, but as somebody who likes trends and likes momentum, I actually think we're looking at silver probably coming down to 22. That's where our low was back in November, and I think that's pretty likely at this point. Now, the one positive for silver is we're way below the 200-day moving average. So whenever silver does turn like it has done for the last number of months, actually last couple of years, I think we're looking at a pretty significant move up percentage-wise, even if it doesn't push us into new territory. I mean, we're at the point where we're talking about we talked about this last week, right? A 20-25% trading range.
Well, that's right. And with the ratio being at 89 too, that's a lot of potential energy waiting to turn kinetic, right? So you've got a lot of pressure building with silver finally taking off and decreasing that ratio, narrowing that ratio down. Just like what we've seen with platinum and palladium. We alluded to that briefly, really close to being on parity, and anybody that has been acquiring platinum the last few years at a 50-60% discount to palladium, that's an early sign of an opportunity for ratio trade. But in those metals, Rob, it's not a small gain. It tends to be big gains.
Big gains. Yeah.
So we're going to wait patiently and see what happens and lock that in. But we're always a fundamental away from something reversing, right? So whether or not we get down to where we tend to see those algorithms get hit, the predictive points that Miles points out each week is just completely dependent upon decisions being made. So when people ask what's it going to do, we don't know what people are going to do. We don't know what the Fed's going to do. You and I are having a great conversation about the Federal Reserve and the lending rate and interest rates in general.
Well, interest rates since 1980, with $1 trillion worth of debt, we hit our high on long-term interest rates of over 14%. Now, some rates were higher than that. In 2020, 40 years later, the 30-year bond rate was at 1%. So obviously that has changed. The trend is reversing. And that peak that hit in 1980 at 14% came off of the low in, say, around 1950. 30 years earlier, just over 2%. So we went in 1950, went from just over 2% to over 14%. 30 years later, and 40 years after that, we hit the low at 1%. Rates are going higher. I know a lot of people in the real estate market are saying, hey, let's just hold off for a little while. Things are going to change. Let's just wait for things to get back to normal. But to them, normal is the last 5-10 years. We're looking at interest rates that, yes, the Fed will pivot sometime. It's an election year. They like Joe. They want to keep the Democrats in power, is my opinion. I could be wrong about that. But we'll see a pivot. The stocks will rally. We need to talk about the S&P here in a second. But it's not indicating a change in direction. The long-term trend for the next 30 to 40 years are higher interest rates, because we had $1 trillion in 1980 on the national debt. We're $34 trillion now, coming off of the all-time low historically for the United States at 1% in 2020. We're going higher. Interest rates are going higher. Things are not going to get back to normal for lenders. Rates are going to be higher. Home prices are going to suffer. And then that's going to affect the equities market. Let's talk about the S&P 500. Let's see your chart.
Well, that's a good indication, of really we can't get anywhere. There's just not a lot of trust and faith and confidence because, again, people don't know, one, what the Federal Reserve is going to do, but two, even the equities markets rallies are not fundamental. On the weekly commentary, the McIlvaney weekly commentary this week, they do a great job of talking about the debt issue. That's looming, and it is a big monster in the room. And so for us, it's a matter of, look, stagflation, economic inactivity is going to be a problem going forward. And will the Fed continue to do the juicing game? They've been quantitative tightening.
Yeah.
Do they go back to quantitative easing? They've been raising rates. Do they go back to lowering rates to stimulate? And it all comes down really to, do they need to stimulate? If the rates, kind of what you point to, higher for longer, is what we should be expecting. It's a new paradigm for a generation.
Right.
That we are going to see higher rates for longer. So plan accordingly. You may even want to be on the front end of that thing. Even though there's a stagnation in borrowing, the credit markets have tightened so much. Banks are struggling.
Oh, yeah.
And banks, in fact, laid off 66,900 people in 2023. Why is that? That's in the same year you had the 4 large bank failures. And now you've got an uptick in non-performing loans. Since the end of 2022, non-performing or delinquent loans that are 90 days or older in terms of loan activity, up $6 billion to over $24 billion. So you've got $24 billion out there in non-performing loans. And yeah, I understand what they're trying to do. They're trying to cool inflation. But if they cool the economy too much, it also decreases revenues. And that's countered by this enormous debt. So
Right.
now $34 trillion. So
Yeah.
you're right, Rob. We should be entering a higher for longer cycle. I just don't know if, like Miles pointed out at the start of the year, he was so disappointed in Powell talking about cutting rates in 2024. Too soon, too early. He's chickening out. Will they chicken out or will they not?
Well, you have so many things that are happening that aren't getting covered. You know, revenue to the federal government last year fell by $500 billion with unemployment at what, 3 point something percent. So unemployment's very low. People are supposedly working. So why are their tax revenues falling that much in a year?
Yeah, well, that's a really good point because they're lying about the numbers. The CP
think?
lie, they're lying about all of it. And it's working against them, ironically, right? So if they come out and they say unemployment is so low and all these jobs have been added, well, what they've done, 11 of the last 12 months, they've adjusted the job gains lower.
Down.
By 700,000 jobs.
But that never gets picked up.
No, the effect on the equities markets has already happened. The markets react to the initial news. They don't react to the adjustment later. So it's false numbers, and it's working against whether or not they can actually cut rates because there are 7 million just working age men unemployed right now in the United States. 7 million. So you're talking about decreased tax revenues. That's a huge source of it right there. The real unemployment number is closer to 20%. For the working age population in the United States, not 3.5%, but they fall off. These discouraged workers fall off
Right.
of the data table. I don't know what you do about it, but there is so much to watch in 2024. We talk about it here. We all have a sense, a discernment of sorts that is telling us this is the year. This is a big year.
Yeah.
And I don't know what that is. The fundamentals, good luck predicting anything.
The fundamentals are telling us one thing, but we seem to be dancing on the edge of the knife and getting away with it.
Yes.
I just don't know how much longer we can.
Well, and watch what the Federal Reserve does, not listen to what they say they're going to do. Will they be able to do it? I don't know. But to me, with the enormous debt, and David and Kevin talked about this a couple weeks ago, you have to restructure debt. You have to default.
Have to.
And how do you make it palatable? How do you make it so that it doesn't lose global confidence in the U.S. dollar? To me, there's two ways. There's more than two ways, but here are the two. One is war, which certainly seems to be building. The other is another health outbreak, health issue, a disease outbreak, something else, and that's one of the theories that you're starting to hear of other viral strains that are popping up.
The Chinese have already developed a new strain of COVID that's 100% mortality rate on mice that have been altered genetically to be like human within 6 to 8 weeks. Why are they doing that? That report just came out this morning.
So wars and pandemics are very economically stifling. Look at any chart and look at how it plummets and how then you can make the hard decision as to how to get out from underneath the debt burden. Granted, if that doesn't happen, neither of those things happen in 2024. It's still an election cycle year. Right. So regardless of who wins this fall, there's going to be discord. There's going to be division. There's going to be unrest. And I don't know to what level, but we've never been more separated. We've never been more divided as a country. There's never been more of a polar opposite type of a situation. So if it's not the election, and it is one of those two worst case scenarios, all right, but maybe it's a depression of sorts or a superinflation, or, they make some major decision where it's more burdensome on banks and there's more bank failures. All these things are ways to reduce or restructure our debt. And that's on top of things that people see coming down the road, like potentially a cashless society or a CBDC or, digital currency based structure or system. Or
a great taking.
Yep. Good point, right? So those are all kind of for lack of a better term, conspiracy theories.
I was going to say that
But
too.
every one of those, Rob, is capable of suppressing our economy so greatly
Oh, it'd be devastating.
that all of these predictions go out the window. And I'm sorry, but all roads lead to gold in that instance, right? They just do.
But they do. Somebody came up with something better. Tell me.
No, there's just not. But look again at this chart where over the course of 3 years, this year-long candle, there's been a huge volatility, right, Miles? But yet
It's the road
gone
to
nowhere.
nowhere. Yeah,
Right.
the road to nowhere.
And granted, it has performed very well in the last 20 years, but guess what's outperformed the S&P 500?
Would it be gold?
Would it be gold? 20 years and 50 years.
Yeah.
And it gets no attention because people don't make money on it for having assets under management. It's private, and there are a lot of different reasons to own gold.
Well, there are four main reasons, and when you talk to a Wall Street type, to him, if it goes up, you make money, you sell it, yay. Otherwise it's a pet rock. A lot of people are buying gold and silver for the second reason, in case the wheels do come off in the zombie apocalypse and they need to have it to buy stuff with. Okay, I get that. And
Barter type of economy.
Yeah, and I'm okay with that. I mean, I keep some of that also. But a lot of people are looking at it like capital, just a place to put their money. Let's wait this out, 5 years or maybe 10, as we start seeing how all these fundamentals that do matter, how they're going to play out. And then if suddenly it takes 50 ounces of gold to buy a 3-bedroom, 2-bath house, okay, instead of 200 or 100, okay, depending upon where you live, more like 200. Or the ratio between gold and the blue chip stock index of the Dow Jones goes from, say, 18 or 20 to 1 down to 3 or 4 to 1, ounces of gold equaling the Dow Jones Industrial Average. These are historic ratios.
Repetitive ratios.
Repetitive,
Not just one-time historic.
Yeah. And so then 5 or 10 years, you take that third of the money you've invested in gold and you reallocate it because suddenly it's worth a lot more than a third of your liquid assets. But the fourth reason why people buy gold is a legacy asset where their kids or grandkids will have capital in their lifetime if things do fall. I mean, listen, we are sitting on the verge of major shifts happening socially, economically, politically, financially for everybody. As a legacy asset, gold is one of the greatest things that you can pass on to future generations. Those are the major 4 reasons why people do business with us.
It's really, really good point, and I appreciate that clarity. And point number 3, with that asset preservation tool, that tends to be the IRA route. Doesn't have to be.
Right.
But if gold's averaging 8% returns a year over time, that is offsetting the inflation rate. It's way better than sitting in cash.
Yeah.
It is the savings alternative for the majority of savers that are looking to protect their portfolio. But
And there's no
doesn't check.
counterparty risk.
Right. It's a zero risk or risk-free asset.
You are not depending on somebody else's to perform. You're not buying somebody else's debt or obligation.
Right.
It holds its own value. You can fly anywhere in the world, hold up a gold coin and smile, and they know 2 things about you. 1, you're trying to be nice, and 2, you got money.
Be careful who you show it to.
Be careful who you show it to.
Well, is Miles even still here? Miles?
I was taking notes just like everyone else at home. So it's all good.
Well, we'll get off our soapbox here. But anyway, please give us a call if we can help discuss your individual portfolio because, again, with those 4 primary motivators in terms of owning gold, to each his and her own. Everybody's got a different motivation.
Right.
And we've got a solution for that. And that is what we've done for 52 years. And Rob, all of those 52, Miles and I, not so long. So just kidding. Got to do it again. But that's going to do it for this week's Golden Rule Radio. We appreciate you listening. And as always, Miles, take us out. Tell them where they can find us.
Sure. If you liked what you heard, do the YouTube button pushing stuff right there below the video. Better yet, why not give us a call? You can talk to Rob, Tori, myself, or any of the other advisors here at McIlvaney Precious Metals. We can be reached at 800-525-9556. You can find some additional info on our website at McIlvaney.com. We are on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks again for listening and have a great week.